Jeff Henriksen, founder and CEO of Thorpe Abbotts Capital, joins us now. Jeff, thanks for being with us to digest these numbers in more detail. In the lead up to this quarter, we were all talking about saturation in terms of streaming services. Netflix had prepped us for a downbeat set of results from a number of these streamers. Disney yesterday blowing it out of the water. What are they doing right? Is this about market share gains? Is this about the market actually, in fact, not being saturated? What is your take?
I think it's about their business model mainly. And, as the great Don McLean sang about the day that music died, we've been joking in our office that April 19th was kind of the day that streaming died in the eyes of the market, because that was the day that Netflix had that Hindenburg of a quarter back in Q2. And since then, valuations across the entire space have come way in, and sometimes justified, other times not. And I think in the case with Disney, last night, they really show what a powerhouse their business model is when you can, they're not just a DTC business. They're not just a streaming business. I mean, that's kind of an entree into this larger ecosystem, and their ability to monetize that across all fronts is quite impressive. And I think last night, the numbers that came in just showed, how powerful it is. Now, it's not all puppy dogs and ice cream. Obviously, the billion-plus loss at DTC, I think, is driving rightfully questions about the future unit economics of DTC. And that's kind of where the work that we're doing on a lot of these names is trying to understand really two things: the linear business, what's the decline, the fade rate there, and then what are the future unit economics of DTC look like. But there are a lot of opportunities in the space, and I think Disney is showing that not all is lost for the media space.
In terms of that DTC or direct-to-consumer business, yesterday Disney announced this new pricing structure offering in the U.S. Disney Plus with no ads, $10.99 a month, Disney Plus with ads, $7.99 a month, and then a bundle as well. How do you think it's going to work? And is this about hedging so that if we do enter a downturn, for example, they now have the ability to retain customers and just simply offer the option for people to switch maybe from the subscription service to the ad service? How is it going to work?
Yeah, I mean, I think so. When we look at DTC, there are good things and bad things about DTC. I mean, let's start with the bad, right? I mean, linear businesses, like linear cable, for instance, if you had networks that you were selling to the big cable operators, that was a very profitable business because you had a ton of people that didn't even watch your content that were still paying for it. And there's really nothing better than that. And with DTC, you have to go out and directly get them. So you have very high customer acquisition costs. Obviously, we know that you have high content costs. And I don't know the number. I know we've talked to a lot of people in the industry, but I've heard numbers thrown around that the overall TAM of DTC might be 15% of what linear was. And so there's a lot of questions marks around DTC. What we think, and I think you can get this from the Disney call, is that the ad component, this AVOD component, might really be the savior of the future unit economics of these business models, because the ability to monetize smart ads, and even if you're talking about the potential of doing shoppable ads, future take rates, there's a lot of interesting ad tech that can go into DTC. And I think that's the unknown component around the future value of DTC. But I do think when you're seeing Disney come out with this model, they're signaling that that's how they see the future of their streaming product. And I think it makes a lot of sense.